the last sort of 2 decades, if you like, were the benefit of very, very low interest rates, very low real yields, and a real yield is just the nominal interest rate adjusted for inflation. You know, for much of the last 2 decades, we had negative yields, negative real yields, and that benefited that 60-40 portfolio really well. If you look at it, the benign inflation environment and low negative yields meant that the correlation between bond and equity prices was slightly negative that whole period. And that meant that a 60-40 portfolio did really, really well. When your equities weren't doing so great, your bonds did really well, and vice versa. We think the risk going forward from here is that we're going to have much higher inflation than we've been used to for the last 2 decades. We realise that at the moment that it's heading down, but we think that structurally we'll have higher inflation. The risk of that then is positive correlations between bonds and equities. So with that, you get no benefit from bonds. So if equities are falling, bonds are also falling. So we think the biggest opportunity in portfolio construction is to be open-minded and not to sort of be wedded to the portfolio construction that worked very well for the last 2 decades. To in fact be open to the idea that you need an extra bucket in there, which is these diversifiers, as we call it. We think we're really well placed to handle the next decade because we've been doing this for just over a decade ourselves with the use of diversifiers. And just to remind you, those diversifiers are strategies that we think that can perform regardless of the direction of bonds and equities because you have those in your portfolio. So an exciting time for us in terms of portfolio construction. So at Atrium we have 3 buckets when we consider portfolio construction. We have our growth drivers, which are our equity investments and our equity-like investments, including high-yield credit. We have our diversifiers, which are our liquid alternative strategies, and we have our preservers, which are our cash-like instruments, our government bonds, our very safe investments. So this structurally different environment that we face going forward, we think places a lot of emphasis on that diversifying bucket. Because a higher level of inflation brings with it higher macroeconomic volatility. It changes the nature of the relationship between bonds and equities. So we go from that environment of the last 2 decades of having a slightly negative correlation, which was great for 60-40 portfolios, to having a positive correlation. And so you just can't rely on the government bonds being that ballast in portfolios. You really need a solid, well-constructed diversifiers bucket. And in that diversifiers bucket, you're going to have absolute return strategies. Those absolute return strategies are going to be able to generate you returns in your portfolio regardless of what's happening with equities and regardless of what's happening with bonds and maybe even regardless of what's happening with foreign currency investments that you might have. So it doesn't change our approach because we've actually been engaged in this approach for the last decade, but we feel really well placed for handling what we see as a different investing environment going forward. I think the most important thing is having conviction in a strategy or an asset that is going to be an absolute return strategy. And that involves really sort of getting under the hood of the strategy, whether it be an equity-based strategy or a macroeconomic-based strategy, and understanding the true drivers of returns of the strategy or the asset. Because often they may think they have an asset that's diversifying, but in fact it shares a lot of the risks that might be in their equity portfolio, for example. So a good one, or in their bond portfolio, a good one might be property. People think that property, and for a long time, an office tower, for example, was very diversifying. You know, a large office tower with its long-term lease was an asset that looked uncorrelated to equities and bonds. But we've seen more recently that those valuations are under pressure, and some of the risks that are in those assets are the same risks that are in parts of the equity market and in the bond market with yields going higher. So what you really need to is get under the hood and understand the strategies intimately and the risks that you're taking on within those strategies, and make sure that they're not overlapping with other parts of your portfolio. Something we feel quite strongly about is that 60-40 portfolio plus some residential property, for example, which would have been a feature of a lot of investors' investment portfolios over the last sort of 2 decades. We're not sure that's the best portfolio to have going forward with higher interest rates and risk around equity markets and bond markets moving together. We think that's not a particularly well diversified portfolio at the moment.